Today we're looking at a specific deferral adjustment or adjusting journal entry for supplies and supplies expense. Now, if you need a quick refresher on what a deferral is, I'll leave a link to that lesson in the description below. But since I'm using the accrual accounting method, at the end of the month, I need to make some adjusting journal entries before I can prepare financial statements for that period. Now, in this situation, the $900 of supplies that I previously purchased earlier in the month, only $350 remains at month end. So the reason I need to make an adjustment, well, there's two reasons. Number one, the supplies that I purchased previously is an asset. And so if at the end of the month on my financial statement, I'm going to have a balance sheet with supplies of $900, when in reality, there's only $350 left. So I need to make my balance sheet accurate. The second reason is because of the expense recognition or matching principle, I want those supplies expenses to be matched up with the revenues that they helped generate early throughout that month. So if you need a quick refresher on the expense recognition or matching principle, I'll also leave a link to that in the description below. So before we get into this, let's first go to our accounting equation with our T accounts and quickly, make sure we know how to distinguish our debits from credits and increases in assets. So first of all, assets equals liabilities plus owner equity. We're going to put pluses on the outside because additions to assets are debits. And let's not forget debits on the left, credits on the right. Okay, so we have plus signs on the outsides. Obviously, the opposite would be reductions. Now, liabilities follow owner's equity because they're on the same side of the equal sign. Now, I also included revenues and expenses below. So revenues follow equity and expenses are the opposite. There we go. So our original journal entry for this $900 of supplies would have looked something like this. We would have debited our supplies because this is an increase to an asset. Our supplies are an asset. So I'm actually going to enter it in our T account. This would have been for $900. So a debit in the supply column. And now we're going to credit cash because we paid for these supplies right away. And this would have been a reduction to an asset. So that balances. Now, at the end of the month, again, we have $350 left. So we're going to take the beginning balance of $900 and we're going to subtract the ending balance of $350. And we're going to have $450 of supplies used. All right, so now what we need to do is make the adjusting entry for this. So if we know we used $450 worth of these supplies, which is an asset, we are going to be decreasing the asset by that amount. How do we decrease an asset? With a credit. So let's fill that in. Here's our debit side, here's our credit side. We're going to credit our supplies or reduce that asset by $450. And we'll add that on the credit side of our supplies T account. Now the debit to that is going to be the expense for that period. And how do we increase expenses? Obviously through a debit. So we're going to debit supplies expense for $450. And we'll put that on the debit side of our supplies expense T account. And so what we're left over with is we're going to reduce 900 by 450, and then we have our $350 leftover supplies, which also matches our ending balance. And that's how you make the adjusting entry for supplies and supplies expense.